Welcome everybody. This is Miscellaneous Lecture 4, and we are going to talk about modern monetary theory. So it is obviously a complement to modern monetary theory that I'm going to spend a whole lecture talking about it. Unfortunately, the title of the lecture is going to be not only is modern monetary theory wrong, it is also dangerously wrong, so you can see that that will take a little bit of time to explain. Modern monetary theory has sort of taken over from where Keynesian economics left off. It's a populist theory, and when I say that, what I mean is it's telling politicians what they want to hear. Namely, they can spend more money and they can spend more money and they can carry on spending until they hit the wall of demand pull inflation. And should they get any inflation that occurs before we achieve a particular employment target, then don't worry, that's cost push inflation, not demand pull inflation. So it's what politicians want to hear. It's gathering followers. There's a lot of weight behind it, and a lot of people thinking that particularly during these rather difficult times, that modern monetary theory is the way forward. It's the way that we are going to get us out of our current problems, and we will leave it all to government. Now, modern monetary theory uses the same assumptions that Keynesian economics used, and unfortunately these assumptions are wrong. I have explained these in other lectures why they're wrong, but I'll quickly recap. MMT assumes that there are output gaps in the economy, and they're the gaps between what an economy could produce if it was using all its resources fully and what it is actually producing. So if you've got 3 or 4 million people unemployed, you could obviously produce a lot more if you could employ those people. Now, the mistake is not in identifying an output gap. The mistake is in thinking it can be closed by a fiscal and monetary stimulus. This is what Keynesians thought and were wrong, and this is exactly what modern monetary theory assumes. There is an output gap and it can be closed by fiscal and monetary stimuli. Both Keynesian economics and modern monetary theory have to have a way of explaining why you do get some inflation even when there is relatively high unemployment. And the only way that you can argue this is if you look at a cause of inflation which was called cost push inflation. Now again, in other parts of my writings and lectures, I have explained why cost push inflation is a fallacy. Just a quick reminder, inflation by definition must be more units of money used in the same number of transactions. More units of money cannot come from rises in costs. So oil prices going up, wages going up, they don't increase the number of units of money in the economy. They change relative prices, but they don't change the average level of prices. Cost push inflation is a fallacy. There is no such thing as cost push inflation, which is a second problem for modern monetary theory. Both Keynesian economics and modern monetary theorists accept the Phillips curve trade-off. Now, the Phillips curve trade-off explained by Keynesians is that there is a relationship between the level of employment in the economy and inflation. And as you get closer and closer to full employment, so you will get more and more inflation. As you get more and more unemployment, so you'll move away from inflation and even into deflation. That's the Phillips trade-off. Again, it's wrong. the Phillips curve was not a trade-off between inflation and employment levels. It was a trade-off between employment levels and wages, and a fairly obvious one. Bill Phillips just proved it statistically and evidence-based, where you would expect what is going to happen happens. If there's lots of unemployment around, then wages tend to be stable or fall because people are desperate to work. Where unemployment is very low or employment is very high, then the only way that you can increase your workforce is by competing with other producers for that labour. So that tends to push up wages. Now, because in the Keynesian model wages are a cause of inflation, they say, well, let's jump straight to the Phillips curve here, and let's say that the trade-off is between employment levels and inflation, not employment levels and wages. So that's another mistake that is made by both Keynesians and modern monetary theorists. Also, Keynesians and modern monetary theorists assume that a capitalist economy where there isn't government or much government intervention is naturally a fluctuating economy. Cycles of business, trade cycles of ups and downs in the economy, booms, depressions, that's the normal events that occur under a capitalist economy, and government stabilisation policy is required. It is necessary for the government to stabilise the economy at a high level of employment and remove these fluctuations in economic activity. Now again, elsewhere I've explained that I don't agree with that statement, that you get fluctuations in economies often caused by government action, particularly with regard to monetary policy. So fluctuations are not natural in a capitalist economy, they're imposed upon it by monetary mismanagement by government. So that's my fourth point of criticism. I'm going to look specifically at 4 mistakes that modern monetary theory makes on top of these assumptions, and they are to do with the causes of inflation and hyperinflation, the role of the quantity of money in the economy, the role of the price of money or the rate of interest in the economy, and their job guarantee scheme. Unfortunately, if you build a model upon wrong assumptions, then the next stage up, the next level up, you're going to get mistakes as well, and I'm going to deal with each of these mistakes as set out there. Stephanie Kelton, a modern monetary theorist, she actually said all inflations for the last 100 years are cost push inflations. Now you cannot be more wrong than that if I'm right, namely inflation is more units of money used in the same number of transactions. So there can only ever be a monetary cause of inflation, and cost push inflations cannot exist. Wages going up, oil prices going up, energy prices going up. These things cannot raise the average level of prices. They can change relative prices, but they cannot raise the average level of prices. So we start with a statement from a prominent modern monetary theorist, which is incorrect. It would have been correct to say all inflations for the last 100 years are monetary caused inflations, or we could let the Keynesians off with their demand pull explanation, but their demand pull explanation only ever works at full employment, and of course all inflations can occur at less than full employment or full employment, and therefore they must all be when there's excessive monetary demand in the economy. Now, Keynesians and MMT need a way to explain how inflation can occur with deficient aggregate demand, and higher unemployment, and therefore they have got to use this cost push argument. And if you look back over the last 100 years, you will see them using oil price rises, particularly in the 70s, commodity price rises, wages, rising, falling exchange rates, and none of these can cause inflation, but MMT says they are the only cause of inflation over the last 100 years. Now, if we take the next step up from inflation to hyperinflation, then again modern monetary theory misses the point over hyperinflation. They say there are many causes of hyperinflation which usually start with a contraction in the real economy. Now, they miss out a step, and I'll explain the step that they miss out, because all hyperinflations have only one cause. It's just that there are many causes of turning on the printing presses. How do you define hyperinflation? Well, an arbitrary 50% a month was decided to be hyperinflation by some economists, and certainly 50% a month is remarkably high, but we've had a lot higher than that, and we often just with hyperinflation just get accelerating inflation until the currency collapses. If you go to Germany, between 1914 and 1926, it actually reached a monthly rate of inflation. Now, this is monthly, not yearly, a monthly rate of inflation of 29,500%. The argument was it was off the gold standard, there were war reparations, there was rebuilding the economy, sort of lots of different causes. That was the rate of inflation. In Greece, October 1943 to December 1944, their monthly inflation rate was 13,800%. They cited World War II as their problem. Hungary, between August 1945 and July 1946, they reached a daily rate, this is daily rate now, of 207% inflation per day. They claimed it was supply side shocks, recovery from World War II, and the depreciation of its currency, the pengo, which eventually was replaced by the forint. Yugoslavia, April 1992 to January 1994, they reached a daily rate of inflation of 64.6%, claiming that the disintegration of Yugoslavia into its component parts was the cause. Argentina, now have they had hyperinflation or not? Interesting one, because between 1975 and 1990, so a long period of time, then they reached 300%, but that was only 300% per year, although some of those months were 50%, and the usual reasons cited for this were weak government. Zimbabwe, a later addition to our hyperinflations between March 2007 and November 2008, their hyperinflation reached a daily rate of 98%, and they cited, or it was cited, there was government profligacy, overspending, and just an inability to raise taxes. So there's lots of different causes used to explain why these countries had hyperinflations, but all hyperinflations only have one thing in common, and that is money printing. In every single case of hyperinflation, there is money printing. MMT confuse what causes the money printing with the cause of hyperinflation. There are many causes which turn on the printing presses, such as those we have identified. If they don't turn on the printing presses, then you won't get hyperinflation. You can have all those causes, don't turn on the printing presses, there's no hyperinflation. Which leads us to quite a clear explanation of what causes hyperinflation. It is turning on the printing presses. It is excessive monetary creation, accelerating monetary demand, which causes prices to be pulled up at very, very fast rates until, as happened with the Weimar inflation in Germany, until the currency collapses and the Reichsmark was then replaced by the Deutschmark. The Germans stopped printing money and hyperinflation stopped, inflation stopped, and indeed since 1926 Germany has been one of the beacons of being able to control inflation, because it really knows what the cause of hyperinflation is. It is exactly that. It is printing money excessively and an excessive growth in monetary demand. So that's the first thing that MMT gets wrong, is its causes of inflation, and it sort of deflects attention away from the fact that their model needs certain things to happen that might cause inflation, but we need to explain all of those inflations in a different way from the real cause of inflation. Mistake number one. Big mistake number two. This is about the understanding that modern monetary theorists have over the role of the quantity of money in the economy. In fact, almost everything that you read about MMT focuses on the importance of money and the positive effects it can have in and on the economy if it's used wisely under MMT tuition guidance. So firstly, I'm going to look at the MMT misinterpretation of the quantity of money role in the economy. And then I'm going to look at a third mistake regarding their understanding of the price of money, or the rate of interest. Now, what MMT failed to realise is that money is only important in a sort of negative and damaging way. Money cannot create jobs, it cannot grow the economy, it cannot be a source of investment, it cannot deal with wealth and income inequalities, etc. It does none of those things, despite what MMT may tell you. If money is managed well, then the economy will function at its best. But if it's managed badly, then all it does is damage the economy, and every single thing that MMT talks about with regard to managing the quantity of money can only be damaging unless it's done perfectly, as I would again describe in other things that I have written. Now, I hope this is not the case, but it does seem that MMT failed to recognise that money existed long before government management of money took over. The earliest forms of mass money were the monetary metals, gold and silver, and in the UK before 1844's Bank Charter Act, the economy ran reasonably efficiently, at least in monetary terms, with consumers buying products, people paying taxes, government spending, people saving, people borrowing, which are all things MMT wants you to believe would only happen effectively if government manages money. In fact, one of the things I'll look at again soon is this statement of MMT that we need a public sector deficit to finance private sector savings. Again, totally, I can see where they're coming from. They always remind me, modern monetary theorists, of a group of accountants who don't really understand much economics, but can look at accounts perfectly and look at all sides of the balance sheet, look at a profit and loss account, and see something which economists will tell you is not there. Now, MMT makes statements such as government spending creates money, whereas government taxation destroys money. These are statements that misunderstand the circular flow of income, for which we have to thank John Maynard Keynes, and his withdrawals from the circular flow of income, one of which is taxation, and its injections back into the circular flow of income not money, which happens when government spends that money. These things are continuously, and for the most part simultaneously, going on in the economy. So there's there's a zero effect on money, no influence on money one way or the other. It is therefore misleading to suggest in any way that they are separate and unrelated events, that one is money creation, the other is money destruction. That isn't the case. Remember, these are just withdrawals and injections into the circular flow of income. Even worse, to suggest that they are money flows when they are actually income and spending flows. They're not money flows, they're the way that money measures income and spending flows. Of course, it is possible for government and the central bank to tax people, refuse to spend the money back into the economy, or even destroy the currency that they take out of the economy, as they did after the First World War in their misguided attempt to return to the pre-war gold standard. So it's possible that you can sort of step one step, two steps and get to money destruction, but it's very rare that that would ever happen. And as it did happen and caused enormous problems after World War I, I'm sure it won't happen again. Alternatively, the government could spend money and refuse to finance it through taxation. If they spend money and refuse to finance it through taxation, then for part of it, it's possible that they could leave some debt unsold at a central bank, which would have money printed against it. So there are links, but it's not simple and straightforward as MMT would like to suggest. So for the most part, what you would have in an economy is just mismanaging flows of income. It's nothing at all to do with changing monetary aggregates. MMT say that government must overspend their budget to create private sector savings. Again, this is an incorrect statement, as government can balance their budget or even have a budget surplus, and the private sector could still be saving more or less, and will do so relative to changes in their income, their expectations, or their confidence about the future. And this can be totally unrelated to government spending and taxation, or the balance between the two. Now, one of the other modern monetary theorist luminaries, Warren Mosler, he makes an important distinction between vertical and horizontal money, and rather obscures the point that all fiat money, which is money not backed by anything other than itself, has changed from something that had value in use, when it was gold or silver, into something which only has a value in exchange. All fiat currencies have just two components, which are currency that can be created by the central bank and bank credit money that's created by private sector bank loans. About 5% of all fiat money in the UK is currency, sometimes referred to as base money. However, 95% of money was created by bank lending, and it is this important component of money that produces another error when MMT say that money is debt. 95% of fiat money was created by issuing debt, but once it has been issued, it is no longer debt. It's just money that can be used again and again as a unit of account. It measures income, it measures saving, it measures consumer spending, it measures government spending, investment, acts as a store of value and a standard of deferred payment. When we were on the gold standard, money was debt, as it was a receipt for gold. But as a fiat currency, there is no debt involved when one £20 note can only be changed for another £20 note. Mosler also argues that when governments spend, this is vertical exogenous money creation, and when banks issue loans, this is horizontal or endogenous money creation. Private banks issuing net new loans, that's more new loans than were cancelled over the same time period, do increase the stock of money. However, government spending has no effect on money creation unless it is financed by money printing. And this occurs, as I said before, if some of the fiscal deficit for 1 year is left unsold at the central bank. A last point, although there are many more that could be considered, is the mistake in terminology that Wynne Godley made and MMT have picked up on when they identify financial sectoral flows and balances as money when they are in fact flows of income and spending. And flows of income and spending that sum to zero. They're not money flows, they're income flows. Throughout their work, MMT failed to distinguish between monetary and fiscal policy. In reality, it is very simple to totally separate fiscal policy and monetary policy. And once the clear difference between them has been understood, then it's easy to see how they can act together or in opposition to each other. The money supply and monetary demand can be expanded or contracted irrespective of whether the government is running a fiscal balance that's zero, in deficit or in surplus. The surplus is an interesting one, much more difficult to grasp this, where what happens to money is totally irrelevant to the government budgeting for a surplus, but I assure you it's there. And once this clear separation has been understood, then the analysis of each of their roles can be seen when they are acting apart or acting together in pursuit of some economic outcome. When this is understood, it's easier to grasp how a large budget deficit could have no effect whatsoever on the money supply, while a small budget deficit can have a large impact on the money supply. It all depends how the debt is financed, not how large it is. So a large debt financed by selling debt to real people is non-inflationary. A small debt financed by printing money, leaving the debt unsold at the central bank, can have a large influence on money. So it is important that you understand the misunderstanding that MMT has when it's talking to you and explaining money flows as opposed to income flows. The third mistake that they make is with regard to the rate of interest. Civilizations come and go, and it's often the result of money mismanagement, or more importantly, the theories that allow this monetary mismanagement to take place. Usually as we get closer to elections, we move closer to silly season for government spending. The latest economic theory that tells government what they want to hear is the one that says for a government that issues its own tokens, currency, the real rate of interest, or the price of money, is zero. This implies that there is no cost to overspending a budget and borrowing. MMT obliges here by telling this to politicians. Another MMT luminary, Bill Mitchell, he wrote, "The natural rate of interest is zero. The The reasoning behind this statement is clear. If you were to make a number of very questionable assumptions, which are actually Keynesian in origin and have been subsequently adapted by modern monetary theory. Firstly, Bill Murchie chooses a target for full employment in the economy. Bill likes 2% unemployment. And this actually gives almost every economy in the world the intellectual support to kickstart spending. Any country that has a higher level of unemployment is then described as having an output gap with insufficient demand to achieve its full employment target. The solution is then to close this output gap by increasing demand in the economy, and the easiest way to do this is to increase government spending. This is incorrect, as I explained in another article that you can find on my blog called Government Spending Does Not Cause the Economy to Grow. However, in MMT world, it is possible for government to boost aggregate demand by spending more money, which does not require further taxation. And there is already deficient demand in the economy if we haven't got full employment. This is proven by the fact that the full employment target has not been reached. This additional spending can then be financed by creating more tokens, more money, and not incurring any service charge because the equivalent rate of interest is zero. Further to this, you can then roll over maturing debt and not incur any repayment charge. It all sounds too good to be true. And of course it is too good to be true, and this is why. All countries have a natural level of employment or unemployment based upon their institutional factors. Again, this is something I've explained elsewhere, but let me recap quickly. If you're a country that has, say, very high welfare benefits, if you're unemployed, then you'll have more unemployed people. So unemployment will be 3%, 4%, 5%. If you have a country that has no welfare benefits at all, you work or you die, you starve, then you will find that the unemployment is very low, 2%, 1%, 0.5%, whatever. So all countries have this natural level of employment and unemployment, and a well-run monetary policy will tend to cause countries to settle at their natural level. And there's no manipulation of demand that can do anything to this. They will just settle at this number. Now, badly run policies may cause this level to rise above the natural level, but no amount of demand management can permanently reduce the level of unemployment below the natural level. Therefore, as soon as MMT's excessive token printing takes place, what does it do? It adds to the future rate of inflation. Initially, MMT have this position covered. As I previously stated, Stephanie Kelton pointed out that all inflations for the last 100 years have been cost push in nature. However, we now know, don't we, that all inflations result from excessive monetary demand, and if any country has any inflation, no matter how low, then it must have been and be associated with excessive monetary demand. So whatever level of unemployment you look at, if you've got inflation, you must have excessive monetary demand, not deficient monetary demand. In reality, it is necessary for a growing economy to be supported by growing monetary demand in order to allow more goods and services to be traded at the same average level of prices. This is why it is necessary to have a central bank with an inflation target to manage monetary growth as close as possible to a target of 2% above the rate of growth of output, in other words, achieving an inflation of 2%. 2% is not great. Naught would be better, but naught has its problems of us drifting into deflation. So through experience, we've tended to find around the world that a 2% target is the best possible target for the economy. The very last thing an economy needs is a government driven by an incorrect theory, guessing about how much money to create and spend into the economy. This is especially true when we take into account that there's a 12 to 18 month time lag between permanent money creation and inflation. It is easy for government to get carried away and print for 18 months before the inflation wall is hit. And by then it's too late to stop a very high rate of inflation because it's already embedded in the economy. I'll talk a little bit more about it later, but the 1970s in the UK was a great example of this. And for any of you reading this or listening to this in 4 or 5 years' time, 2021 will be a great example of a lot of money printing that took place at the end of 2020 and at the beginning of 2021 being recorded eventually in much higher inflation. And if I'm wrong, you better stop reading now. At present, profligate spending by a UK government trying to deal with a pandemic, not in the best possible way I might add, has produced a national debt in excess of £2 trillion and a yearly servicing charge in excess of £50 billion, which is more than the whole defence budget. The debt is financed by the taxpayer, and as the national debt and debt servicing has increased, so government has had to cut back in other areas of spending, and this has mistakenly been referred to as austerity. In fact, more debt and more spending is just being more or less profligate. Overall, the government has a significant financial burden that makes it susceptible to any theory that suggests that national debt and its servicing can be written off as long as unemployment is above 2%, which is what MMT are saying. There are many economic theories in addition to MMT that suggest the government's budget is different from the budget of a household, and therefore a government does not have to abide by the same rules of fiscal prudence that you and I observe. This is correct in only one sense, and that is that household finances need to be in order at the point of death. The fact that governments, theoretically, do not die does not mean its finances should not be in good order. Suppose you were told that you were going to live forever and therefore your loans would never need to be repaid, but your financing of those loans would need to be sustainable. It is exactly the same for government, but some economic theories like MMT, like Keynesian theories, profligacy is acceptable, and if anything goes wrong, government is reminded that they know someone, their central bank, who prints money. That's not the way to have an efficient, well-run economy. The idea that the natural rate of interest is zero is an economic myth. If the government wants to borrow money, it must compete with the private sector for the funds that have been created by the incomes of that private sector. The government does not earn an income. Market interest rates are never a nominal zero, and modern monetary theory needs to be reminded that there is a structure to interest rates determined by risk, amount and term, that acronym RAT. The structure ranges from low rates of interest at the secured end, mortgages, and high rates of interest at the unsecured end, credit cards and payday loans. At present, the Bank of England's bank rate is distorting the secured end and having very little effect at the unsecured end of this structure of interest rates. Just think about what would happen if all the central banks of the world reduced their official rates to ZERP or 0%. If they did this, there would be damaging asset bubbles in stock markets, housing and other assets. People will reduce savings at zero and negative rates. The bond market would produce zero or negative returns. The earning capacity required to support pensions would be destroyed, forcing people to speculatively buy assets that they do not need in order to create rent and capital gains, particularly for when they retire. A good job we're not seeing that happening now, isn't it, in 2021? Oh yes, just listen back over what I said, and of course that is exactly what is happening with the central banks of the world bringing interest rates down to 0% or even negative. You see asset bubbles, housing bubbles, stock market bubbles, a reduction in savings, and people being forced out of their pensions and into buying speculatively profits where they can create rents, etc. So it's actually happening. Look carefully at that. So just let me remove this myth that there's a natural rate of interest in the economy and it's zero, and that there's only one rate of interest in the economy, because there is a whole structure of interest rates which currently range from 0.01% in the UK economy to 2,000+% when you go to payday loans and other very highly insecure financial markets. To the last, mistake 4 of MMT, which is the job guarantee. Anything that interferes with the pricing or supply of labour to labour markets is damaging to the economy. Historically, interfering in labour markets has been seen as politically popular, while its damaging effects have been kept out of sight. Again, in other articles, I have explained why the Equal Pay Act was unnecessary, why minimum wage legislation does more harm than good by distorting labour markets and interrupting the freedom of contract between employers who demand labour and employees who agree to work for that given wage. At this point, I should make it clear that I'm not against eradicating low incomes and poverty. It's just that there is a much more efficient way of doing this, and that's through reverse or negative income tax, something that I explained in one of the previous miscellaneous lectures. So if you want to know more about that, do go back and read that. This negative or reverse income tax does not interfere with pricing in labour markets, and as well as removing the poverty trap, it gives everyone incentive to work, even if only part-time, which no other system does. At this point, let me introduce you to the MMT version of interference in labour markets. It's called the Job Guarantee Scheme, and it will be politically popular, as are all other MMT mistakes. It's very easy to have a job guarantee scheme in any command economy. If you look back at the communist USSR or China at the beginning of the previous century, you'll see very high levels of employment backed by fear and compulsion. In fact, when I was in Russia talking to some older Russians, the one thing they all seem to miss is job security. So you can create it in a command economy. And even now in countries like the UK and the USA, it would be relatively easy to say that everyone who receives benefits for not working should just present themselves at the relevant office on Monday and be assigned their work for the week. So it's reasonably easy to force people to work, but it's not really part of the ethos of a free market capitalist system. Neither of the situations previously identified will be politically popular, and it is therefore interesting to see how MMT sell their version of the job guarantee. They say it would be government funded, which means of course it would be taxpayer funded. It would not be compulsory. It would create a living wage. Sounds great, doesn't it? And it would raise the income floor, providing public purpose jobs with a permanent program in a stable economy. Sounds good, doesn't it? And so to the criticism of this. If you provide people with a living wage for working outside the labour market, then you certainly raise the income floor, as all labour markets that were paying below that wage will lose employees until they are paying at that rate or above that rate. This will increase the number of people claiming that living wage. All those with wages just above the living wage will argue that their differentials have been eroded and no longer reflect their skills and contribution to the economy, so they'll be pushing up wages in that way. Public purpose jobs already exist in the economy, and those that have been invented by government, central or local, and of which there is an infinite number, will both waste resources and draw labour away from jobs that consumers are willing to pay those people to do. Overall, the job guarantee scheme will be an inefficient increase in the tax burden and an increase in government spending. I explained earlier that there is no way to manipulate aggregate monetary demand to achieve some mythical 2% of the workforce unemployed. If this proposed scheme was introduced, there would still be underemployed resources costing the taxpayer ever increasing amounts to maintain a scheme that promised to be sustainable and permanent. So, 4 things wrong that I have explained in a little bit more detail. A couple of concluding points for you. There is actually clear evidence that MMT will not work in the UK economy. Although it was called Keynesian economics, it was following exactly the same principles in 1970, or the decade of the 1970s, when Keynesians set a 2.5% unemployment target, which they thought that they could reach without hitting the inflation wall. They used fiscal and monetary stimulus. Surprisingly, that caused inflation to rise to 5%. They argued it was cost-push inflation caused by higher import prices, and they still had an output gap as unemployment was above target. They continued with fiscal and monetary stimulation, and when inflation hit 10%, they argued it was oil prices. There was still an output gap that needed to be closed, and when it reached 15%, they argued it was wages. Inflation continued throughout the 70s to rise to just under 30% over one 12-month period. The unemployment target was never reached, and the general consensus was that fiscal and monetary expansions do not work. All they do is distort markets and cause stagflation. So if you want to know why MMT will not work, just look back at the 1970s. Again, on my blog you can read an article which says what really happened in the 70s, and that will explain it to you. Now, a final few words, particularly for Warren Mosler, given the misunderstanding he expresses in his Deadly Innocent Frauds of Economic Policy, and for Stephanie Kelton in the misunderstanding of budget deficits, which is expressed in the deficit myth. All government spending is financed by current and future taxpayers. That is, if we include inflation as a future tax on money. This year's spending will be financed by taxation and borrowing. Any borrowing left unsold at the bank will have money printed against it, and this will reduce the value of the current money stock in circulation. All the other borrowing, which which is financed by selling debt to real people, will impose a future cost on future generations in terms of servicing that debt, and that borrowing will further reduce funds available for savings and investment in the private sector. All of this means that higher government spending now will mean higher taxation tomorrow. So please read carefully what modern monetary theorists suggest. Look carefully at what I have said and make up your own mind. I hope you have enjoyed that, and I'll come back with another miscellaneous lecture soon. Thank you.